There is no sign on the door, no logo in the lobby, no teller window, no hold music, no mobile app with a 5-star rating on the App Store. And that is entirely the point. Somewhere above the 40th floor of an ordinary-looking office tower, in New York, in Geneva, in Singapore, 15 people manage the entire financial life of a single family. They don't manage your money, or mine, or thousands of strangers pooled into a fund. They manage one family's capital across investments, taxes, real estate, philanthropy, security, and succession. And they answer to exactly one client. This is the private family office, and it is, quietly, one of the most consequential financial structures in the world, controlling, by some industry estimates, trillions of dollars in assets globally, almost entirely outside the visibility of the public markets and the public eye. Today we're going inside it, why it exists, why old money dynasties build them instead of simply banking like the rest of us, and why, in 2026, this structure has become more relevant, not less, in an increasingly volatile world. Let's begin with the wall. The hidden walls of generational wealth. Why the ultra-wealthy view retail banks as public utilities, not partners. To understand why dynasties build family offices, you first need to understand how the ultra-wealthy actually perceive a retail bank, because it is fundamentally different from how the rest of us perceive it. For most people, a bank is a convenience and, at times, a partner. It holds your paycheck, processes your mortgage, perhaps offers you a wealth advisor, if your balance crosses a certain threshold. It feels personal because the relationship is the largest financial relationship in your life. For a family controlling several $100 million or more, the calculus is entirely different. A retail bank, even a private wealth division of a major retail bank, is, in their eyes, a regulated public utility. It exists within a banking system designed for mass market stability, mass market compliance, and mass market risk tolerance. It is built to serve millions of depositors simultaneously, under regulatory frameworks designed to protect the system, not necessarily to optimize for any single family's specific, idiosyncratic goals. This matters enormously for a few concrete reasons. First, counterparty risk at scale. A retail bank, by definition, takes deposits from a vast number of people and lends or invests that capital broadly. It is structurally exposed to systemic shocks, liquidity crunches, interest rate shifts, regulatory intervention, even outright failure. The 2023 regional banking crisis in the United States, in which several mid-sized banks collapsed within days, was a vivid recent reminder to ultra-wealthy families that even well-capitalized institutions can become insolvent with startling speed. A family with several $100 million sitting in any single institution is, in a real sense, exposed to that institution's fate. Second, the advisor conflict. Private bankers and wealth advisors at retail institutions are, however, well-intentioned, typically compensated on products, proprietary funds, in-house investment vehicles, fee-generating structures that benefit the bank as much as, or more than, the client. The family office model removes this conflict almost entirely because the staff are employed directly by the family, with compensation structures designed around the family's actual outcomes, not the bank's product pipeline. Third, and this is the one most outsiders underestimate, standardization itself is the risk. Retail and even private banks operate at scale, which means their products, their compliance processes, their reporting structures, and their service models are necessarily standardized. A family with complex, multi-jurisdictional assets an operating business, philanthropic commitments, and succession concerns spanning 3 generations does not fit neatly into a standardized product menu. Old money dynasties don't want to be served by a system built for everyone. They want a system built only for them. This is the foundational mental shift. The retail bank is infrastructure for the public. The family office is infrastructure for one bloodline. And dynasties have learned, often through hard experience, that those 2 things are not interchangeable. Control, privacy, and the architecture of the family office contrast the standard banking experience with what happens inside a dedicated family office, and the difference in control becomes stark. In a retail or even private banking relationship, the client is, structurally, a counterparty to the institution. The bank holds the assets. In its name or in custody arrangements, it controls. Under terms, it largely dictates, subject to its own risk committees, its own compliance department, and its own regulatory examiners. The client receives statements, makes requests, and operates within the bank's architecture. In a family office, the assets are typically held through structures the family itself owns and controls. Trusts, holding companies, limited partnerships, administered by a staff that works exclusively for the family. There is no shared infrastructure, no shared risk pool, no other client whose needs might, even subtly, compete for resources or attention. Every decision, which custodian to use, which jurisdiction to operate in, which counterparties to trust, how aggressively to pursue a deal, is made for the benefit of a single family, by people whose only job is that family's outcome. Privacy follows the same logic. A retail or private bank, no matter how discreet, exists within a regulatory and reporting environment designed for transparency to regulators and, in many jurisdictions, increasing transparency to tax authorities and even the public through beneficial ownership registries. A family office, while still subject to legal and tax obligations, structures the family's affairs in a way that minimizes the public-facing footprint. Fewer institutions know what the family owns. Fewer systems contain the data, and fewer employees outside a tightly vetted circle ever see the complete picture. From customer to owner, the psychological shift. There's a psychological dimension to this transition that's worth dwelling on, because it explains why families who can afford virtually any private banking relationship in the world still choose to build their own infrastructure instead. When you are a customer of a bank, even an extraordinarily well-served customer, you are, by definition, operating inside someone else's system. You are renting infrastructure. The bank's risk appetite shapes what's available to you. The bank's compliance posture shapes how quickly things move. The bank's commercial interests shape what gets recommended to you. You are important to that institution, perhaps very important, but you are still, fundamentally, a guest within walls someone else built. The family office represents a transition from customer to owner, not just of assets, but of the entire financial ecosystem surrounding those assets. The family owns the relationship with each custodian, each law firm, each accountant, each investment manager, rather than receiving those relationships prepackaged by a single institution. The family sets the risk parameters, not a centralized risk committee serving thousands of other clients simultaneously. The family decides what gets reported to whom, on what timeline, and through what channel. This shift has a real psychological dimension for the principals involved. Many ultra-wealthy individuals describe the decision to build a family office as the moment they stopped feeling like they were being served and started feeling like they were in command. Not commanding their money in a hands-on day-to-day sense, necessarily, but commanding the architecture within which that money operates. It is the difference between living in a house you rent, however luxurious, and living in a house you built to your own specification on land you own outright. This is ultimately the foundational reason family offices exist at all. Everything that follows in this video, the direct investing, the discretion infrastructure, the governance systems, flows from this single shift, from being a customer of someone else's system to becoming the owner of your own. The power of personalized direct investing, bypassing funds, direct ownership in AI and energy infrastructure. If the first reason family offices exist is control over the architecture, the second is control over the capital itself. And nowhere is this more visible than in how dynasties now invest. The traditional model of wealthy investing, committing capital to a private equity fund or venture fund, which then deploys it across a portfolio of companies on the investor's behalf, is increasingly viewed by family offices as an expensive, slow, and indirect way to access opportunity. Recent industry data illustrates just how decisively the shift away from that model has moved. Over 70% of family offices are now engaged in direct investments, with many continuing to increase their allocations toward this approach. The logic is straightforward once you see it from the inside. Direct investing eliminates layers of management fees and carried interest that would otherwise be paid to a fund manager, while also giving the family far greater control over which specific opportunities it backs, how those investments align with its sector expertise, and how its broader values and long-term goals are reflected in the portfolio. One participant at a recent industry roundtable summarized the psychological dimension of this shift memorably. Families have come to associate the word fund with fees and lockup periods, while the word deal evokes the prospect of actually making money. This has driven family offices into direct ownership positions in precisely the sectors reshaping the global economy in 2026. AI and machine learning deal values more than doubled between 2024 and 2026 as family offices moved directly into emerging artificial intelligence companies, not through a venture fund's diversified basket, but through direct equity stakes negotiated, structured, and held by the family's own investment team. The same pattern has emerged in energy infrastructure, where dynasties are taking direct positions in data centers, private power generation, and grid-adjacent infrastructure assets, sectors increasingly viewed as foundational to the AI economy and increasingly attractive to capital that doesn't need quarterly liquidity. Why can family offices do this when most investors can't? Because a substantial majority of family offices were originally born from operating businesses, meaning many of their principals and senior staff understand how to actually run and evaluate a company at an operational level, often more intimately than analysts at a large institutional fund ever would. This is sometimes called the operator-first advantage. A family that built its fortune in manufacturing, energy, or technology brings genuine operational literacy to evaluating a new AI company or energy asset, rather than relying purely on financial modeling. Club deals, dynasties. Pooling capital before the public ever sees it. The single most important structural innovation in family office investing over the past several years has been the rise of the club deal. And by 2026, this is no longer a niche tactic. It is, by most measures, the dominant model. The numbers here are genuinely striking. Club deals now represent 60% of direct investment volume, according to PwC's analysis, while research focused specifically on the U.S. market puts the figure even higher. Club deals have emerged as the dominant investment model, accounting for over 70% of U.S. family office transactions. Other industry data from the first half of 2026 places club deal participation at 69% of family office investments. Different methodologies, but a consistent and unmistakable signal. Collaborative, off-market investing has become the default, not the exception. Here's how it actually works. Rather than each family independently sourcing, diligencing, and negotiating an investment, which requires substantial internal infrastructure, most single-family offices don't want to build for every sector. Families increasingly pool capital and expertise with a small number of trusted peer families to acquire stakes in private companies, real assets, or infrastructure projects before those assets ever reach a public exchange or even a broad institutional fundraising process. A family with deep expertise in a particular sector, semiconductors, artificial intelligence, real estate, will often take the lead in evaluating and structuring a transaction, while other families participate alongside them as co-investors, drawn together through industry events, curated networks, and increasingly tight-knit peer communities. This isn't simply about sharing risk, although that matters. It's about sourcing entirely off-market deal flow that never touches a public process at all. By the time a hot AI company or an energy infrastructure project reaches a public funding round, let alone an IPO, the most attractive, ownership stakes have frequently already been allocated among a small circle of family offices who got there first, through relationships, not auctions. There is also a generational dimension to this trend that's worth noting. Industry analysts have observed what's sometimes called the next-gen effect, a tendency among younger family members to prefer investing alongside a like-minded cohort of peers and friends, rather than through the more solitary, institutional-style fund commitments their parents' generation favored. As control passes to the next generation of dynastic wealth, club deals are likely to become even more central to how that capital is deployed. The 50-year horizon. Why retail products cannot compete. There is one advantage family offices possess that almost no other category of capital in the world can claim: genuine indifference to quarterly performance. A mutual fund manager is evaluated, retained, or fired based substantially on rolling quarterly and annual performance relative to a benchmark. A hedge fund faces redemption pressure if a bad quarter spooks its limited partners. Even most institutional asset managers, pension funds, endowments, operate under boards and stakeholders who scrutinize relatively short performance windows, however much they claim to be long-term investors. A family office answers to none of that. Industry data captures this clearly in how family offices set return expectations. Family offices generally target 2 to 5 times returns, occasionally reaching 10 times, and prioritize capital preservation alongside long-term growth. A fundamentally different posture from traditional venture capital, which requires outsized power law returns, because the majority of its portfolio is expected to fail outright. This patience compounds into something retail products structurally cannot replicate: capital that can genuinely wait. During periods of market dislocation, families holding patient, flexible capital are positioned to act as liquidity providers themselves, potentially accessing attractive opportunities precisely when other, more constrained investors are forced to sell. When markets panic and retail investors are forced into redemptions, family office capital frequently moves in the opposite direction, buying, not selling, because there is no redemption notice to honor, no quarterly call to defend, and often no intention of selling for decades. This is the 50-year horizon in practice. A dynasty doesn't need this quarter's energy infrastructure investment to pay off this year. It needs that infrastructure to still be generating value when the grandchildren of the current principals are making decisions about it. No retail product, structurally bound by quarterly reporting cycles and annual redemption rights, can credibly offer that. Infrastructure for absolute discretion. The 2026 data privacy landscape wealth that cannot be seen is, in a meaningful sense, wealth that cannot be targeted by litigants, by kidnappers, by hostile governments, or simply by an increasingly intrusive digital surveillance environment. This is the logic behind the third major reason family offices exist. Discretion as infrastructure, not as an afterthought. The 2026 data environment makes this more urgent than it was even 5 years ago. Beneficial ownership registries have expanded across multiple jurisdictions, requiring increasing transparency about who actually controls a given entity. Data breaches at financial institutions, even well-regarded ones, have become a recurring feature of the news cycle, and the rise of sophisticated AI-assisted social engineering has made it dramatically easier for bad actors to assemble a detailed financial profile of a target from fragments of publicly available information. Family offices respond to this environment by treating data architecture itself as a core security function, not an IT afterthought. This typically means proprietary, often air-gapped or heavily segmented systems for the most sensitive financial data, deliberately avoiding the shared cloud infrastructure that a retail bank, by necessity given its scale, relies on. It means structuring ownership across multiple layered entities, specifically so that no single registry, no single database breach, and no single disgruntled employee could ever expose the complete picture of what the family owns and where. It also means minimizing the family's digital footprint as a deliberate strategy, not a passive habit. Fewer accounts, fewer institutions with visibility into the full picture, fewer points where information about the family's holdings could leak, whether through negligence, breach, or malicious insider action. Gatekeepers, the vetting of family office. Staff, because a family office, by design, concentrates an extraordinary amount of sensitive information and decision-making power in a very small number of people. The vetting of staff becomes one of the most consequential and least discussed functions of the entire structure. Unlike a retail bank, where any individual employee typically has access to only a narrow slice of any client's information, a senior family office staff member may have visibility into nearly everything: the family's full balance sheet, its succession plans, its security arrangements, even sensitive personal and health information about family members. This concentration of access makes the hiring and ongoing vetting process exceptionally rigorous, often closer in rigor to a national security clearance process than a typical financial services hire. This vetting typically extends well beyond standard background checks. It includes deep reference verification, stretching back years, assessment of an individual's own financial discipline and behavior, psychological evaluation in many cases, and, critically, ongoing monitoring rather than a one-time check at hiring. Staff are trained specifically to recognize social engineering attempts: the fraudulent phone call impersonating a family member in distress, the convincingly forged legal document requesting an urgent wire transfer, the seemingly innocuous LinkedIn connection request. That is, in fact, the opening move of a reconnaissance effort against the family. These staff function, in effect, as a human firewall, gatekeepers whose explicit job is to stand between the family and the universe of legal threats, fraud attempts, and social engineering schemes that increasing wealth visibility inevitably attracts. Their loyalty, their judgment, and their discretion are, in a very real sense, as valuable an asset as any investment the family holds. Jurisdictional diversification, spreading the bloodline's risk. The final layer of discretion infrastructure operates at the level of geography and law itself. Family offices increasingly structure a family's assets, residency options, and even succession planning across multiple jurisdictions, not to evade legitimate tax obligations, but to insulate the family from the risk of any single country's political, economic, or legal instability. Recent industry commentary captures this shift clearly. Families are layering dynastic and asset protection trusts, thinking carefully about jurisdiction and designing structures that can adapt to changing exemptions, information sharing regimes, and political climates, rather than betting everything on any one set of rules. This requires earlier and more deliberate planning, with greater emphasis on the portability of trusts, the management teams overseeing them, and even the family's own domicile. This diversification has also reshaped where family offices themselves are physically located. Emerging hubs such as the UAE and Singapore have attracted significant family office capital in recent years, with Singapore alone now hosting more family offices than New York City or London combined. This is not a coincidence. It reflects a deliberate, decades-long calculation by dynasties about which jurisdictions offer the most stable, most favorable, and most discreet long-term environment for multi-generational capital, regardless of where the family's social and cultural life is actually centered. The underlying principle is the same one that drove the family office's existence in the first place. Never concentrate critical risk in a single point of failure, not in a single bank, not in a single employee, and not ultimately in a single country's legal system. Preserving the bloodline through governance beyond money, human capital, and the education of heirs. Here is the uncomfortable truth that every sophisticated family office is built to confront directly. Capital is, historically, far easier to preserve than the family that holds it. The numbers on this are sobering and remarkably consistent across multiple independent studies. Research from the Williams Group has found that 70% of wealth transfers to the next generation fail, and 90% fail by the third generation. Similarly, data from the Family Business Institute indicates that roughly 30% of family businesses remain family-controlled into the second generation, about 12% continue into the third, and only approximately 3% persist into the fourth generation or beyond. One white paper studying families with a median net worth between $600 million and $800 million found an even starker figure. A widespread sense among advisors that around 80% of families with significant wealth or businesses will eventually succumb to this same pattern of decline. This pattern has a name in nearly every culture on Earth. Proof that it's a human phenomenon, not a uniquely American one. Americans call it shirt sleeves to shirt sleeves in 3 generations. In China, the same idea is expressed as from peasant shoes to peasant shoes in 3 generations. Italians say from the stable to the stars and back again, and the Scots put it most bluntly: the father buys, the son builds, the grandchild sells, and his son begs. The modern family office exists, in significant part, as a direct structural response to this pattern, built on the recognition that too many wealth holders pass on the assets of a fortune without passing on the knowledge and skills it actually took to create that fortune, focusing intensely on the balance sheet while neglecting the human element of preparing successors for genuine stewardship. This is why sophisticated family offices have, in recent years, built out structured education programs for rising generations, sometimes informally described as wealth boot camps, covering investment literacy, tax fundamentals, governance participation, and the family's own history and values. Wealthy families increasingly engage banks and financial advisors, specifically to educate heirs through these structured courses, treating the preparation of the next generation with the same seriousness as the preparation of any other major asset. The family office, in this sense, manages not just financial capital, but what's increasingly called human capital, the judgment, literacy, and values of the people who will eventually inherit control. The Family Constitution, a rule book against collapse. The single most important governance tool deployed by sophisticated family offices is the Family Constitution, a formal, often extensively negotiated document that establishes how the family will actually function across generations. A family constitution is a formal governance document establishing the principles, values, and operational framework for managing family wealth, businesses, and relationships across multiple generations, functioning as both a rulebook and a compass, providing structure for decision-making while transmitting core values to the generations that follow. These documents vary enormously in scope and formality. Concise versions run 5 to 15 pages and focus on core principles for smaller families, while comprehensive versions for large, complex, multi-generational families can run 30 to over 100 pages, sometimes supplemented by separate, more easily updated policy documents. What goes into one of these documents? Families typically outline the roles and responsibilities of each family member, document how often the family will meet to discuss decisions and goals, and describe precisely how financial decisions will be made and by whom. More sophisticated versions also address direct questions of access. Under what conditions can a family member draw on capital? What milestones, educational, professional, or otherwise, must be met before a younger family member gains greater control, and how disputes between family members will be resolved before they ever reach a courtroom, or worse, the press. Crucially, well-structured family constitutions deliberately address both the soft elements of family life, values and communication, and the hard elements of governance, including ownership structures and decision rights, with clear pathways for next-generation involvement designed so that younger family members develop genuine competence and earn their roles, rather than simply inheriting authority automatically. The Rockefeller family is frequently cited as the clearest proof that this approach works. The family's wealth has been managed through one of the earliest and most pioneering family office structures in American history, and as of recent estimates, the family's collective wealth stands at approximately $11 billion as it enters its 7th generation, a direct contradiction of the shirt sleeves pattern that has claimed the overwhelming majority of comparably wealthy families. The difference consistently comes down to governance. Families that build deliberate structures for communication, education, and shared decision-making dramatically outperform families that rely on informal trust and good intentions alone. Philanthropy and legacy, the family office as reputation architect. Finally, the family office increasingly takes on a role that extends well beyond investment management and into the deliberate construction of a dynasty's public legacy. Structuring and managing the family's philanthropic and impact activities. This has become a more technical discipline than it might first appear. Philanthropy is increasingly approached systematically, including through strategies like deduction bunching, grouping multiple years of charitable contributions into a single tax year to exceed the standard deduction threshold, and structures such as charitable remainder annuity trusts and charitable remainder unit trusts, which allow families holding appreciated, low-cost basis stock to generate a charitable contribution while simultaneously addressing the capital gains exposure on those assets. Beyond the tax mechanics, family offices increasingly treat philanthropy as a genuine governance and engagement tool for the next generation. Appointing younger family members to philanthropic or impact investing committees gives them real decision-making experience and responsibility well before they're handed control over the family's core capital, building judgment in a lower-stakes environment, while simultaneously cementing the family's reputation and legacy in the communities and causes it chooses to support. A dynasty's name on a hospital wing, a university program, or a conservation initiative isn't simply generosity. It's a deliberate multi-generational reputation strategy, and the family office is increasingly the architecture through which that strategy is designed and executed. The modern tech stack of the ultra-rich, from paperwork to decentralized ledgers and private clouds. The technology underpinning family offices has changed substantially in just the past few years, and 2026 marks a particularly visible inflection point. The traditional model of wealth administration, paper trust documents, manual reconciliation between custodians, periodic reporting that arrived weeks after the fact, is being steadily replaced by infrastructure built specifically for a single family's exclusive use. Private, often heavily segmented cloud environments now allow family offices to maintain real-time visibility into a complex multi-entity, multi-jurisdiction portfolio that would have required armies of accountants to track even a decade ago. Distributed ledger and blockchain-based record-keeping, increasingly used for tracking ownership stakes in private assets, and even some categories of real estate and alternative investments, offers a tamper-resistant, instantly verifiable record of ownership that doesn't depend on any single custodian's internal systems, remaining accurate or even remaining operational. This matters directly for everything discussed earlier in this video. The more a family's records exist in proprietary, family-controlled infrastructure rather than shared institutional systems, the more genuine discretion and control the family retains, and the less exposed it is to a breach, failure, or change in policy at any third-party institution. AI-driven risk management, small teams, outsized capability. Perhaps the most significant technological shift, though, is the way artificial intelligence has changed what a small, lean family office team is actually capable of doing. Where a traditional family office might once have needed to hire a substantial internal research team to properly diligence a direct investment opportunity, AI tools have radically compressed that timeline. One family office investor described being able to create a dedicated analytical agent for each prospective deal, producing detailed research reports within roughly 30 minutes, allowing a small team to evaluate opportunities with a speed and thoroughness that would previously have required a much larger staff. This cuts in both directions, and sophisticated family offices are alert to the risk as much as the opportunity. The same participants cautioned that AI is increasingly being used by the companies seeking investment themselves to generate financial projections and business models that can appear highly polished on the surface, but require careful, skeptical scrutiny before any capital is committed. The family offices that benefit most from this technology are the ones using it to compress diligence timelines without compromising judgment, treating AI-generated analysis as a powerful first draft, not a final verdict. The broader effect is structural. AI-driven research, modeling, and risk management tools allow a family office staffed by a dozen or 15 people to operate with an analytical capability that would have required 50 or 100 employees a decade ago, closing much of the gap that used to exist between a nimble single-family office and the institutional research departments of major global banks, without ever requiring the family to sacrifice the privacy or control that drove them away from those institutions in the first place. The ultimate status symbol and survival tool. Bring all of this together, and the picture that emerges is not simply about money, it's about architecture. A retail bank account signals that you participate in the financial system everyone else participates in. A private family office signals something else entirely, that your family has built, deliberately, expensively, and often over multiple generations, an entire private financial ecosystem that exists for no purpose other than the preservation and advancement of your own bloodline. That is why, in 2026, the family office remains the ultimate status marker among the ultra-wealthy, not because of its cost, though it is genuinely expensive to operate, but because of what it represents. A family that has graduated from being served by the financial system to owning its own piece of that system outright. And in an increasingly volatile global environment, marked by banking instability, expanding data transparency regimes, geopolitical fragmentation, and rapid technological change, the family office has become something more than a status symbol. It has become, for the dynasties that build them well, a genuine survival tool, a structure flexible enough to move capital where it's needed, discreet enough to avoid becoming a target, and governed carefully enough to ensure that the family controlling it all still exists, intact and capable, in 50 years' time. The retail bank was built to serve everyone, equally, at scale. The family office was built to serve one family, completely, for generations. That difference is the entire story. If you found this valuable, subscribe. We go deep on the real architecture of dynastic wealth every week, the mechanisms most channels never explain. Let me know in the comments, which part of this surprised you most? The club deals, the governance structures, or the AI shift inside these offices? I'll see you in the next one.